The Reserve Bank of New Zealand cuts 50 basis points and signals more to come. Australia's wage growth is lighter than expected, which is good news for the RBA ahead of January's jobs figures today, which are set to show a solid labour market. That's coming up in our 5 Things in 5 Minutes on Thursday, February the 20th. And then in today's bonus deep dive interview, ANZ Economist Maddy Dunk highlights how Australia's capital city housing markets have faced a bit of a struggle in the lead up to the RBA cutting rates.
If I look at our ANZ CoreLogic Housing Affordability Report, it highlights that housing affordability is a big challenge right now, particularly in places like Sydney.
But first, in 5 and 5 with ANZ, global markets were mixed overnight, awaiting more tariff details and minutes from the US Federal Reserve. The focus was in Australasia. Following yesterday's hawkish cut by the RBA, all eyes yesterday were on New Zealand's central bank as to whether they'd catch the bug or continue to forecast further easing after the 50 basis point cut to 3.75%, which was delivered on the day. ANZ New Zealand chief economist Sharon Zollner says a key takeaway was the RBNZ's tone as it made the announcement.
I'd say it was confident, balanced but confident. They certainly reminded everyone that forecasts are always conditional and that they expect to cut further if the data comes out as they expect. But nonetheless, I think they sounded extremely confident about the path of medium-term inflation from here. They acknowledged there could be a few bumps in inflation because of the fall in the exchange rate, that imports could be a bit more expensive, but really sounded like they think they've got this one in the bag and they can look through that sort of noise.
As of 4 a.m. Sydney-Melbourne time, the S&P 500 and US Treasury yields were flat. The US dollar index was up 0.26%, the Aussie dollar down 0.17% at 63.41 US cents, and the Kiwi was flat at 57.01 US cents. Number 2. Sharon says the RBNZ's confidence comes even as some components of domestic inflation remain stubbornly sticky.
Things like high insurance costs, high local council rates bills, that sort of thing. But essentially, domestic inflation tends to react to where the economy was 6 to 12 months ago, and it was in a pretty dark place actually back then. So the Reserve Bank's confidence that that medium-term inflation is going to continue falling back to where it needs to be has gradually increased over time. And I think at the end of the day, that was why they were confident delivering the 50 today that they had earlier signalled, but also showing a slightly faster fall in rates over the next 12 months as well.
Number 3. That faster projected fall in rates over the next 12 months has led ANZ Research to pencil in more rate cuts from the RBNZ through this cycle than just the one previously forecast.
It looks like a 25 basis point in April is the plan, and I would expect markets to gravitate towards that. Indeed, they already had. Beyond that, we've put in a couple more cuts, so we've now got cuts in April, May and July, taking the OCR to 3%. The 3% is the middle of the Reserve Bank's range for what the neutral official cash rate is. The idea being that if life stopped happening, then the OCR could just sort of stay there with neither a brake nor an accelerator for the economy.
Number 4. The Reserve Bank of Australia yesterday put a big focus on the labour market weakening for any clues that it might cut rates again this year. Australia's January jobs figures today are expected by ANZ Research to show the unemployment rate steady at 4%. But there was a glimmer in Q4 wage data, which softened to 3.2% annually from 3.6% in Q3. ANZ Economist Maddy Dunk says that was weaker than expected.
We still feel like one rate cut is what we're likely to see from the RBA from here on out. But it is something that you need to watch how the data evolves, looking at how the labour markets perform, particularly over the second half of 2024. It does suggest that the bulk of that decline in wages growth is behind us, but we'll be watching to see how that evolves.
Number 5. Indonesia's central bank held its benchmark rate at 5.75% yesterday after last month's surprise rate cut. ANZ economist Crystal Tan says Bank Indonesia maintained an easing bias because it needs to support growth, but noted timing of cuts depended on global developments.
The timing of cuts is going to depend very much on the global situation. So what we'll be watching is not only the dollar-rupiah trajectory, but also how the rupiah performs relative to its regional peers. If global conditions turn more benign, the rupiah performs well, then that would be the window for Bank Indonesia to cut.
Crystal Tan there. Now, in our bonus deep dive interview, Maddy Dunk looks into why housing markets in Australia's capital cities have struggled in the lead up to the RBA starting its rate cuts.
We have seen that Australia's housing market has been slowing, particularly in the capital cities. Actually, if you look at the regions are looking far more resilient than the capital cities. But I think that weakness has been most evident in places like Melbourne in particular. We've seen that Melbourne housing prices have been in decline for 10 months in a row now. And that weakness has started to seep through into places such as Sydney. Sydney prices have fallen for 4 months in a row. And in aggregate, the capital city housing prices have been also declining for 4 months in a row. And it's just not the fact that you're seeing some of those capital cities are recording declines. It's also places like Adelaide, Perth and Brisbane where price growth had been incredibly strong, that the pace of that growth has slowed significantly. And looking at some of the leading indicators we like to look at, things like auction clearance rates, for example, house price expectations, time on the market, all of these things do suggest that the market is going to remain reasonably soggy, at least in the near term.
Yeah, what sort of challenges are sellers facing? So I guess you've got a strong labour market, you've got the expectation that rates would start coming down. So would you expect that it could be a bit easier to sell a house across these cities? Or what challenges are they seeing?
Look, I think one of the biggest challenges for sellers at the moment is affordability. It's really quite challenging for people to get into the market at the moment, given how much housing prices have risen over the last few years in particular, but it's been a long-run trend here in Australia. Now, if I look at our ANZ CoreLogic Housing Affordability Report, it highlights that housing affordability is a big challenge right now, particularly in places like Sydney. And if you look at the different price groups, what we're seeing is that the falls in capital city housing prices are concentrated in those more expensive properties, going to that story that it is just very challenging in that top end of the market at the moment if people want to either upgrade or get into that portion of the market. And indeed, it had also been coming through in what we were seeing in house prices versus unit prices. For a long time, house prices had been growing much faster than unit prices. That was really a COVID story where people wanted more space. But I think that affordability challenge has meant that you've seen a pickup in unit prices recently. So yes, financial stability isn't a concern. The labour market's still pretty tight. People have jobs. People are keeping up with those repayments. But the fact that housing prices are so expensive relative to the growth that we've seen in people's incomes is meaning that we might have hit somewhat of a ceiling for at least the near term in some of these capital cities.
Maddy Dunk there. I'm Bernard Hickey. That was 5 and 5 with ANZ for Thursday, February the 20th. Catch you tomorrow with analysis of whether Australia's January jobs data provides another clue that the RBA might cut again this year. This podcast contains general information only, not investment advice. You should obtain advice for your personal circumstances before making any investment decisions. Please view the podcast disclaimer available via your media player or email.